A private placement offering refers to a method used by entrepreneurs to raise capital for their businesses by selling shares in their company to a small group of sophisticated investors. Typical investors in a PPO include institutional investors, like mutual funds, insurance companies, pension funds, and also high net worth individuals. Although private placement companies are subject to regulation by the Securities and Exchange Commission, they do not have to be registered with the SEC if certain requirements are met. These private placement offering requirements are stipulated in an SEC rule called Regulation D. The argument goes that the purchasers in a private placement offering are sophisticated investors who have the ability to do their due diligence when buying shares, and intervention by the government will only force the issuing company to incur costs that cut into their excess returns. A private placement therefore gives the issuing company a significant amount of flexibility in the disclosures it makes to potential investors. Regulation D consists of 3 rules that companies must adhere to if they wish to be exempt of any registration requirement with the SEC. Rule 504 applies to companies who are trying to raise up to $1 million in a 12-month period, and a firm can only use it so long as it is not considered a blank check company. These are businesses with no formal business plans, where the purpose of the organization is to merge or be acquired by another corporation. Under Rule 505, companies cannot advertise or use conventional solicitation methods to sell the securities. Companies may sell to as many accredited investors as it wants, but it is limited to 35 other people who do not meet the sophistication or wealth standards associated with other exemptions. Rule 506 has the same restrictions as 505, but all investors in the issuing company must have enough knowledge and financial analysis to properly evaluate the investment. Under Rule 506, companies can raise an unlimited amount of money, making it a very popular exemption for those firms wishing to escape registration requirements with the SEC. A private placement memorandum, often referred to as an offering memorandum, is a legal document that essentially warns investors of the risks associated with the investment, thereby serving as protection to the purchasers of the securities. A PPM will often include a lot of the same information you would find in a public company's annual report, such as the financial statements and a description of the business alongside its risk factors. There are several ways that a company can go about developing a PPM, including through an investment bank that will often already have an extensive network of contacts willing to contribute capital. A company can also approach a PPM specialist firm that specializes in the drafting of offering memorandums. The last way, and perhaps the more traditional approach, is through an attorney familiar with all national and state regulations. The term due diligence was coined in the Securities Act of 1933 that made it clear the role broker-dealers were meant to play in the securities market included research on the securities they were selling. Although originally intended to protect purchasers of securities, sellers will often conduct due diligence on the buyer to make sure the buyer has enough money to make the purchase. In the case of a private placement memorandum, a broker-dealer has the obligation to investigate the securities being issued through a Regulation D representation. The Financial Industry Regulatory Authority requires a broker-dealer to review the issuer and its management, its business prospects, assets it holds or plans to acquire, and the intended use of proceeds from the offering. The last piece of information essential to understanding PPOs is the term sheet. This is a non-binding agreement between the issuing company and the purchaser of the security that outlines the terms and conditions of the investment. This document will not go into extensive detail about the deal, but it will cover the more important aspects of the transaction. This lays the groundwork for a lot of the future documentation produced in a PPM, and it ensures that the legal expenses involved in drawing up a binding agreement are not incurred too soon. A term sheet will often include the amount the issuer is trying to raise, the purchase price, and any rights or preferences associated with that security. Private placement offerings are a great way for smaller companies to finance growth in their operations without having to go through the costly process of an initial public offering. Although proponents of PPO have a legitimate argument against oversight by the SEC, I think there is a very clear need for legislation addressing the role that third-party due diligence firms should play in this process. All issues that take away from the credibility of the private placement memorandum and term sheet need to be addressed if investors are to continue financing business growth this way.